Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for the first time Lyn Alden. Lyn's background lies in the intersection of engineering and finance. She holds a bachelor's degree in electrical engineering and a master's degree in engineering management with a focus on engineering economics and financial modeling. She oversees the finances and day-to-day operations of an engineering facility and has been performing investment research for over 15 years in various public and private capacities. Her work has been editorially featured or cited at Forbes, Business Insider, MarketWatch, Times, Money Magazine, The Daily Telegraph, The Street, CNBC, U.S. News and World Reports, Kiplinger, Huffington Post, and elsewhere. And she is also a regular contributor to Seeking Alpha, FedWeek, and Elliott Wave Trader. Lyn's logical thinking as an engineer rings through to her analysis of the driving forces behind markets and her work to explain what was driving the repo markets last September, and that is really what has alerted me to her excellent work. In fact, my friend Eric Coffin at the Metals Investor Forum first sent me an email telling me of Lyn's work, and which I have been following on a regular basis since then. And you can keep up with her thinking on a regular basis by following her on Twitter, which I do. And you can and most certainly should go to her website, lynalden.com. That's Lyn, LYNALDEN.com, where she provides research and strategy covering stocks, options, precious metals, international equities, and alternative investments with a specialization in asset allocation. And Lyn publishes a newsletter every 6 weeks. I'm looking at one that she put out March titled Crashing Down Through John Exter's Pyramid, and we've certainly talked about John Exter on this show in the past. And then in May, a letter that just came out this morning, hot off the press, titled First Liquidity, Then Solvency. Well, those are certainly topics of interest to me, and I'm sure with many listeners to this show. So let me suggest that, again, that you go to Lyn Alden, LYNALDEN.com to sign up for her free newsletter. And Lyn also puts out research posts from time to time. They keep track of ongoing market dynamics. And one of those that she recently published was titled Quantitative Easing, MMT, and Inflation Deflation. That is really what I want to talk to Lyn today about. So thank you so much for joining us today, Lyn. It's really great to have you with us.
No problem. Thanks for having me.
It's really good to have you. First time again to speak with you after I've read your work first. It's really a pleasure. Lyn, in that article that you wrote, that special article, Quantitative Easing, MMT, and Inflation Deflation, you provided illustrations showing how our federal government traditionally funded itself. It would fund itself by way of borrowing from its citizens and then expanding to borrow from citizens of other countries. Can you contrast those traditional methods of financing with quantitative easing, which was put in play after the 2008 financial crisis?
Yeah, sure. So the article outlines 4 different models of government financing. And then the first one is the more traditional one, which is domestic government borrowing. So in addition to taxing from the population and spending it back into the economy, they also borrow from the citizens and the firms within the country as treasury securities, and then they use that as well to finance their government spending. And that's, it's self-contained, and it's an old system because you can do it with fiat currency, you can do it with gold. That's the traditional way that governments finance themselves. And then Model 2 is international government borrowing. So the United States also borrows from foreign creditors, such as Japan, China, European nations. And that's been a big part of our financing of the past 40, 50 years, especially with the world reserve currency. So, back in the 80s, that was our foreign debt, like held by foreigners, was about 5% of our GDP. But now that's up to over 30% of GDP. So we've increasingly relied on borrowing from foreigners, which is mainly that we send them dollars through trade deficits, and then they recycle those dollars back into borrowing our treasury securities, which we then deploy back into our economy. And then the third option, which is when a government runs out of actual lenders, like either domestic or international. That's what we're seeing more today, where they employ quantitative easing. So the central bank essentially creates dollars and then uses those dollars to buy treasury securities. So you can think of the treasury and central bank as theoretically separate, but in that sense they start working together. And then the fourth model is being more discussed, and that's an MMT model, which essentially takes that third model and more unifies the two between the treasury and the central bank, so that the central bank is more fully monetizing deficits and not really worrying about running large deficits. And that's kind of what we're seeing today.
That sounds kind of adventurous. I wonder how that's going to work out. I want to get to the massive borrowings that the U.S. is facing right now, with all that's going on, even before the current coronavirus situation. It looked pretty ominous to me, but more so now. But I would like to, Lyn, go to this repo crisis issue that I mentioned back in September 2019 when it reared its ugly head. And this was indicating problems. I like to call it, or refer to it as kind of the canary in the coal mine, suggesting there were some issues, some real underlying issues that were in play that weren't really visible until we suddenly saw a 10% spike, I think, very momentarily in September 2019 in the repo market. Can you explain to us what the repo market is and what caused that spike in interest rates? What were the underlying causes for that?
Sure. The repo market is an overnight lending system between banks and financial institutions where they borrow in exchange for providing safe collateral, such as treasuries. Mm-hmm. And normally that's a very low rate. It's a very boring and liquid market. But in mid-September of 2019, that rate suddenly spiked to, as you said, about 10% overnight. And it was something like 2% before. So it just was a massive spike. I haven't seen one of those since 2008. And at the time, there were kind of two camps. One camp was the more mainstream camp, which was, it's not a big deal. It's a technical issue. It's due to corporate seasonal tax payments. It'll resolve quickly. And then the other camp was, worrying that there's a major bank collapse somewhere or some sort of party wasn't being trusted. My analysis generally kind of focused on the middle between those two extremes and showed that it was mainly a treasury oversupply problem. So since the end of 2014, when QE3 ended, U.S. banks, large banks, were filled with about 15% cash levels as a percentage of assets. And they also had about 15% of their assets in treasuries. And then primary dealers, one of their jobs is they have to bid at auction for treasuries. And then they generally resell those treasuries to the rest of the world and to other buyers. But starting after QE3 ended, the dollar became strong, and foreigners were no longer really buying treasuries at the scale they had been. And so we kind of reverted to that first model of financing, where the domestic economy was lending treasuries, like buying treasuries, lending to the federal government. And we actually saw banks become major financiers of the deficit. So over the past 5 years, they drew down their cash levels from 15% all the way down to 7%. And their treasury securities went up from 15% to over 21% of their assets. But the problem with that is right during the week of the repo crisis, they hit their lowest cash levels as a percentage of assets since the global financial crisis, which was about 7%. And so essentially, banks were being forced to buy at auction treasuries, but then unable to readily sell them, particularly T-bills on the secondary market. So they were getting their cash levels were getting crowded out by treasuries. And that's why even before this COVID-19 crisis, back in the autumn of 2019, the Federal Reserve had to come in and start printing dollars to just buy treasuries outright and to start monetizing government debt.
And so you had the specter of massive borrowings by the United States. I mean, Donald Trump has not been anything like a traditional Republican. He's been spending, some would say, like a drunken sailor, spending like crazy, has no limits. The foreigners then were coming forward to buy treasuries. I know you're suggesting that there was a relationship there with a stronger dollar. When the dollar is stronger vis-a-vis other fiat currencies, the foreigners have tended to stay away, and then when it gets weak, they come in and buy. Do you think that's something we can count on in the future, that they'll be back, that the foreigners will be back if the dollar gets weak?
That's uncertain. It's possible that we've saturated our international lending base at this point. We've had 3 major dollar cycles since 1971. So the sample size is pretty small. We have a sample size of 3. So it's hard to say what's going to happen on the 4th cycle. But over the past 3 cycles, that has what happened.
So it seems to me, I mean, Stephen Roach back in 2004, he was an economist with Morgan Stanley. I used to read him faithfully. I picked out something he wrote in 2004 the other day I found in my files, and he was warning that the United States was living beyond its means. It was borrowing too much from foreigners, and it had to stop it. It had to stop its consumption and start financing itself. It seems to me that this is the underlying problem, though, isn't it, Lyn, that the United States has been living beyond its means for so long, and now comes along COVID-19. It seems almost impossible. I mean, how are we going to ever finance this enormous trillions upon trillions of dollars that are being spent now to try to keep the ship afloat? How is this going to work itself out?
Yeah, so in earlier decades, debt as a percentage of GDP was smaller. So whenever foreigners weren't buying as quickly, it was easy for domestic sources of buying to take over. But now that debt, even before the crisis, was over 100% of GDP, and foreigners were not really buying, that left the Fed as the only real buyer of treasuries, which they do so by creating dollars. So as far as I can see now, we're kind of in the phase where the Federal Reserve has to create dollars to buy Treasury securities. Now that, there could be months where they can get away with less of that, and we can go back to actual buying. But for the most part, with deficits this big, the Federal Reserve is going to be the primary buyer for probably quite a while.
And why then would we go from QE to MMT? What would be the advantage? Why would the powers that be do that?
Well, I'm not sure I'd call it an advantage, but it's more just like pointing out what people are discussing these days, which is essentially trying to find ways to get money to the public more readily than these previous mechanisms have. So, for example, if you look at QE from the Great Financial Crisis, most of that went into recapitalizing the banks. It didn't really get to the people.
Right.
Whereas now we're in a situation where the people are the ones that are under threat from this virus, so there are a lot of political efforts to try to get more money to them, and it's a different type of QE essentially than what we saw 12 years ago.
Akin to maybe helicopter money or something like that, you might say.
Essentially, yeah. I mean, the $1,200 checks that many Americans received earlier this year were an initial version of that, and so are extended unemployment benefits.
Well, in your article, you laid out your thinking about, how this could play out. You mentioned John Exter's inverted pyramid in one of your articles that I referred to. I've known, actually have a little bit of a contact to John Exter through a friend of mine who married his daughter. So I've heard a lot about John Exter over the years, and really quite a remarkable man, for sure. But he was always a deflationist. And in your article that we're talking about now, inflation or deflation, it's an ongoing discussion. You can certainly see the deflationary pressures mounting with massive unemployment and bankruptcies and everything else that's bound to start appearing here. But which way do you think it's going to work its way out? You talk about it in the article, and frankly, because we don't have enough time to do justice to your thoughts on this, really people should go to your website and read this article and other things that you write. But maybe just give us a summary with the 3 minutes we have left here, Lyn, to give us an idea of what your thought process is on how this might resolve itself. What will be the outcome of this seemingly disastrous situation we're in?
Sure, yeah. Over the past 4 decades, we've had a very strong disinflationary trend. So we've had lower and lower levels of inflation, at least consumer price inflation, everyday goods. There's different ways to measure it. So there's different discussions on exactly how, how much inflation's changed, but generally it's been a more deflationary trend. And that's, due to rising debt, it's due to aging demographics, a variety of reasons. But once you hit the zero bound, which we're at now, and you start kind of relying on just massive increases in the monetary supply, my analysis points to, we still are a near-term price pressure because, especially in discretionary goods. So as essential goods, we're already seeing some inflation, but for discretionary goods like buying new cars or, buying other large discretionary purchases, this year we're probably looking at a pretty significant deflation. But going forward, inflation is definitely a far more likely outcome over the next several years, in my view.
And you also certainly pay a lot of attention to the precious metals as a way to protect yourself. Would you like to comment on that briefly?
Yeah. So in the current cycle, I started adding gold, silver, and gold stocks to my portfolio in about Q3 of 2018. And I continue to hold them as a pretty important segment of a portfolio.
And this is your personal portfolio. Do you, I guess your newsletter you provide, people can get a pretty good idea of what your thoughts are along these lines on an ongoing basis, right, if they sign up for it?
Yeah, I provide a model portfolio that I also put real money into just to kind of track it along with the readers.
Excellent. Well, I want to thank you so much. We should have you on again sometime, hopefully, to discuss in more detail some of the things that you write about, because I think that you really do provide a lot of great information that can be very helpful to people who aren't focused on the financial realm. So I just want to thank you so much, Lyn, for being with us, and hopefully we can do it again sometime.
Yep. Thanks again for having me.
You're welcome.